So when you look at the silver market right now, what stands out immediately is how different the retail environment feels compared to previous cycles. There's been a strong move higher, yet at the same time you're seeing a noticeable wave of selling coming from individuals. And that can look confusing on the surface. Why sell into strength? But when you dig deeper, a lot of that selling isn't speculative. It's necessity-driven. Cost of living pressure is forcing some holders to take profits, even though the broader move looks unfinished. Francis Hunt has been very clear on this point. Yes, silver has already delivered meaningful gains, and for some people, that's been life-changing. But historically, the most powerful part of a parabolic move doesn't happen early. It happens late. The bulk of the upside tends to compress into the final stretch when momentum accelerates and conviction is tested. That's where discipline matters most, not getting swept up emotionally, and not confusing short-term noise with the end of the trend. From a structural perspective, this is not a straight-line market, and it never is. There are levels where price pauses, churns, and frustrates both buyers and sellers. Those moments often feel dramatic in real time, especially when headline numbers start circulating, but they're part of the process. What ultimately matters is relative performance, particularly how silver behaves against gold. That ratio has historically been the key signal for when silver enters its most aggressive phase. Right now, that relationship suggests the move is still developing, not resolving. There may be volatility along the way, and periods where gold temporarily leads, but the broader staircase remains intact. These pauses are not failures. They're resets that allow the market to reload without exhausting itself too early. In long cycle moves like this, patience often outperforms activity. Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters. I'd love to hear from you in the comments.
An excellent search, real, for me, generational wealth being made and furthermore to be promised. I fear, and having spoken to you and you were mentioning, anywhere between 35 and 50% of the sellers are actually potentially needing to take profit for cost of living based reasons. I would certainly suggest that might be the only sensible reason. If you are in silver and you've done well, I want to highlight the Hunt's law of parabola, and that says 75 to 80% of your gains comes in the last 15% of the move. So if you're doing great now, trust me, you're going to be doing unbelievably well in that final part of the move, providing you don't get completely dopamined up by momentum, which is a crazy old drug of its own. But this is a 4-digit move for us. We've spoken about the localized high of $333 that you might get a bit of chop and churn around there, but then go onwards. And our exit strategy is based off the gold-silver ratio because we're expecting such high degrees of outperformance. So for me, more to come. However, nothing goes up in straight lines, and we did cross a couple of key technical levels. I'm wondering, there's a couple of big levels here, Elijah. We've got 5K looming on gold, and we've got 100K looming on silver. And I'm wondering if, for headline reasons, there might be a little bit more drama in between now and the actual running of that my $5,100 level for silver, which, by the way, puts us very close to the 50 gold-silver ratio, which is a separate discussion, but I'm sure you'll take me there once I've completed my opening comment. So I think they grossly overstate. I think it's like understate, my apologies, let me re-say. The labor numbers are overstated. They're worse than people think they are. And inflation numbers are understated. But anyway, if we debase silver's price performance, you've actually only recently taken the 2011 high on allowing for the all-urban CPI rates. So that brings things looking far more less extreme. People are absolutely bedeviled by the scale of the move. We have, in my opinion, the Gulf of Tonkin incident in 64, the entire run-up through the Vietnam War, that was huge proliferation. And I've mentioned the military-industrial complex, Vietnam, and the amount of munitions that were spent into the eventual Faulkner High. That is our primary one leg up. And since then, we've done 3 separate impulses over a better part of 64 to 24. We're talking the better part of 60 years. We're already now 62 years into this entire structure. And we kind of broke in 24. We were highlighting that with you. We've been with your channel now quite a long time, and we continue to thank you for supporting us, and we hope our support is and our commentary is useful for your viewers. But just to put this into context, we're expecting, don't look at the number, it's not meaningful, it's divided by the inflation rate, but this is a log scale chart. It's very deceptive. If I were to just for a second just put you back on regular and show you that number, that's what I mean by the law of parabola. Okay, that's where we expect you to get. I'm going to put that back on the log scale because it's almost too big for people to conceptualize, and I'm just going to do a percentage move for between here and target. In other words, this is the outperformance we are anticipating for silver against the inflationary statistics that you are given for all urban people, and that's still a further 692%. If we just leave it at 700%, we actually expect outperformance. You don't stop at the purple line. So if we just say 700% plus, that is 8 times against an inflation number as well. So it's not against a fixed level line that is the dollar, against an inflation number. And we spoke, so please, unless you really have to, try avoid selling your silver is my message to all Americans. I want to see you survive this. I want to see you thrive through this. Your silver is your friend. He's going to continue to be your friend. And the biggest gifts come at the end. Trading is a hockey stick career. I'm lucky to have made it across the desert to the hockey stick part. And investing in silver is also a hockey stick event. There's a lot of desert walking, and then suddenly manna from heavens, biblical, I'll get biblical on you. It doesn't stop raining manna on you in the end. So that is one thought I'll leave you with, and I'll go over to the gold silver ratio, which was actually on regarding your question, and show you an interesting point as well there. Let's take the O and gold silver ratio. These are actually weighted candles, so you'll see they're different thickness. This illustrates the amount of volume that is behind something. So it's not a schizophrenic chart of any kind. It is an illustrator of volume. And I'm going to just take some drawing tools off that and show you that we actually had a breakdown here. We kind of a little bit missed this opportunity. So there was a gold overperformance spell just recently in the last couple of days where silver's been a little bit more muted. And that probably comes out of, I'm going to drop to 8 hours just to get a little bit more detail on the day, because I really want to show you this. That comes out of a continuation pattern to the downside. So you may recall, Elijah, we said, when you leave our orange box, which was the 74 value, you should primarily stack silver all the way down. So previously, when we were staying in the containment zone, keep having a 50-50 a little of gold and silver, and then you pivot primarily silver. That is our counsel to ourselves. I'm not regulated to advise you, but that's the take we had and what we gave to our community. If I drop down one more time frame, I just want to get the 4 hour. I think that will be the best.
When people try to frame what's unfolding now by pointing to past silver spikes, they usually fall back on the same comparisons. 1980, 2011, as if history automatically repeats in neat cycles. But as Francis Hunt has pointed out, that mindset is exactly what causes investors to miss structural shifts while they're happening. Those earlier moves were driven by excess leverage and speculative momentum. Once the pressure released, supply rushed back in and prices collapsed. What we're dealing with now is fundamentally different. According to Hunt, this cycle isn't being powered by traders chasing charts. It's being driven by necessity. Industrial demand is no longer a background factor. It's the core driver. Silver isn't optional for modern production, and unlike financial demand, it doesn't disappear when volatility spikes. Manufacturers don't wait for confirmation signals or perfect technical setups. They secure material when they can, because the cost of not having silver is far greater than paying a higher price for it. That's where the misunderstanding creeps in. Many observers are still focused on price swings, assuming volatility means fragility. Hunt argues the opposite. Volatility is a feature of silver, not a warning sign. What matters is what's happening underneath the surface. Inventories are thin, mine supply has struggled to respond for years, and much of global production is tied to byproduct mining, which can't be rapidly scaled even if prices rise sharply.
We have to accept that silver is still more volatile generally than gold. That's going to remain the case. But here's my take relative to 80 and 2011, the 2 years you mentioned. This is going to be a far larger move in nominal terms, the dollar, and it's going to be far more sustained at its previous highs move. In other words, even after whatever turns out to be a pullback and setup will be sustained at a far larger period. So people's ability to time and exit will maybe not be as critical. I still think with the volatility, it helps to have technical analysis, and that's why I'm in here. But nonetheless, you're not going to get the complete washout but down to $4 that you had post the 50 run in 1980, for example. And here's my reasons why. The 1980 run had speculator, my namesake, by the way, bunker hunts, chasing up the silver market. So there was a degree of cornering, but there was supply, and they chased it and they were stacking. And once they got broken, that supply came back in. This is not, and this is the irony, you've actually had a lot of margin increases recently, and you've got to understand the difference between what's driving the move. Is it a horde of retail traders with too much leverage forcing a short squeeze by charging in FOMO buy? Or is it a shortage of actual silver above ground and industrial businesses that absolutely must have silver taking delivery on a far grander scale, concerned about their ability to control and have inventory of an absolutely non-negotiable input, such as in your device, how many ounces silver? Now you're knocking out a few hundred thousand, going on millions of Samsungs of many different models. You can't not have the device, and as a percentage of cost, it's still not huge on the actual device cost, but you have to have it, even if you're paying 5 times for it. And, 5 times the cost of the silver in this device, okay, the device goes up 20%. People will have to eat that. That'll be called inflation. But in fact, it's symbolic of all the debasement of fiat currency, its buying power, and the fact that we're now getting a violent re-rating for multi-decade suppression and a shortfall. So whilst I say gold is a turbocharged vehicle because it's of the inverse parabola of debasement of all fiat currencies that have been synchronized to debase, although the dollar still lost 10 or 11% to the euro last year and was one of the worst, the others were also losing value. You now have silver as a twin turbo. So, think of the Porsche twin turbo. You've got a second turbo. Not only are you benefiting from fiat-based debasement and being a monetary metal like gold, but gold has bullion storage and plenty of supply if it were needed industrially. Silver actually has a supply deficit. There is far greater use of it. You're in negative deficit in terms of usage versus supply. And now the above ground inventory that you were eating away at is now gone. And everybody's in a mad panic to assure that at whatever price they must have. So this is not a retail leverage-based crisis of a short squeeze. A bunker hunt was just a sophisticated, very rich trader investor category. And that's why the margin increases are actually counterproductive. It's an interesting point, force and beneficial for the silver price, because what it actually does is there's only so many retail traders in here. We're not a large part of it, in my opinion. And actually, the Samsungs of this world are going direct to mines to buy and to secure purchase. What's happening is the miners who manage their capital also face margin increases for selling, forward selling in the contract markets. So if you increase the costs or the tie-up of capital, you think you're reducing retail. If retail leverage longs are not the problem, you're actually doing more damage to your price. You're actually pushing it even further because mines are saying, look, the price is moving in our favor. We have to tie up all this capital to forward sell on a short contract until we actually deliver. Why don't we just wait it out? So you're actually reducing the offer stack, which is legitimate producers that have the item and will be able to deliver it in the future. So you're getting a secondary effect that the unintended consequences is reducing supply and futures. And silver miners are saying, why tie up the capital? Market's moving in our favor. We let it run. We can always jump in later. We're making profits. And so I actually think they're thinning the offer stack rather than reducing the bid chase stack, which is not actually the problem. So interesting theory for people to contemplate. And I think that continues to work in our favor. The fact that the usual breaks are actually accelerants this time. It's physical demand and there's no inventories. That's different to all the other years you mentioned. So I can't say for sure what the individual silver miners are doing and say they're not doing it at all. I would imagine that there are still some degrees of activity, but the action taken, which has typically worked, spikes the wheels of leveraged retail long traders that are actually cash traders. They're not buyers. They're not standing for delivery. Typically, they're trying to squeeze the price up. You had the Wall Street Bets, I think, event of a year or two ago. What it does do, it increases the cost and the capital commitment that must be held on margin by people who are selling short as well. You don't have a margin increase for just one side of the entry on the market. If it costs me 10 times more to buy a contract long in tied up margin, it costs the seller the same when he sells in the market. You don't what goes for the night goes for the day, what goes for the buyer goes for the seller. And what that means is you're actually forcing mines to tie up more capital just to do the normal hedging activities. And this might actually put them off and reduce potentially. So this is theory. I can't tell you what the miners are doing, but if I was a miner, I'd say, why do I need to do that? I'm not earning on that part of it. I don't need to forward sell. The market's moving in my favor. I don't need to have that cash and capital tied up. And if the minute I want to sell the entire year's production, I might only sell a third. So who knows what decision processes are being made by miners, but it's not going to be favorable to selling more of their future deliverable produce by increasing the costs and the capital requirements. It's like a home. It's like the home buying market. You know, if you guys are going to face 8% mortgage prices and you've got to put 40% down, what's going to happen to property prices? How many people are going to be rushing to buy? It's going to reduce the buyers. In the same way, that's what it's going to do to sellers of silver who are producers. So I think there's an unintended consequence there, and I think it's all in our favor for higher prices because this is a physical delivery crisis, not a long retail squeeze. This isn't the story of bunker hunt or Wall Street bets. It's been in deficits for years, and to turn all those mines on, you know, you're talking about 15-year cycles, things get mothballed. A lot of the produce, don't forget, is between 60 and 70% of silver is done because of copper, iron ore, zinc, gold. You can't say, hey, while you're down there, make sure you find more of the byproduct. They didn't choose that site for the byproduct. They chose it for the copper, the zinc. The geology was done with a different priority. So, you know, they will bring up what they bring up. And it's unfortunately mines that weren't invested in because of the price suppression mechanism of multi-decades that was the financialization of everything. And it comes back to our most strategic and seminal call of 2020 on the turn of the debt markets. You no longer have a perceived reserve asset in treasuries. And actually, I want to add this as a point, the 10-year popped to the upside in terms of rates. And what happened? Gold surged. It wasn't so much the silver. Why? Because people have lots of money, typically are bond portfolio people, governments, central banks, and institutions. They will have storage issues with silver. They chased gold up, which coincided with our gold-silver ratio breaking down to the downside. So there's quite a lot to absorb there. Let me hand back.
Looking ahead, the setup forming in silver is not pointing toward a typical late-cycle blow-off or a quick retracement back to comfort levels. Francis Hunt's outlook suggests the next phase is about pressure building quietly, not loudly. The market doesn't need excitement anymore. It needs metal, and that distinction matters. Because when demand is driven by necessity rather than speculation, time stops working in favor of patience. What's likely to define the coming period is not a single breakout moment, but a series of price adjustments as availability tightens further. Hunt has emphasized that supply cannot respond fast enough to changing conditions. New mines take years, not months, and much of silver production remains dependent on broader base metal output. If those sectors slow, silver supply tightens even more, regardless of price. That creates a future where higher prices aren't a signal to sell. They're the mechanism required to keep material flowing at all. Another shift expected ahead is how pullbacks are interpreted. Historically, corrections reassured markets that balance was returning. In the next phase, those pauses may simply reveal how little excess inventory exists. Each dip invites demand rather than relieving it, because end users and long-term holders are no longer confident they'll be able to replace metal later at reasonable terms. Hunt views this as the point where psychology flips, not from fear to greed, but from optional ownership to strategic necessity. As this plays out, silver's volatility is unlikely to disappear, but its floor may continue to rise in uneven steps. Instead of dramatic collapses, the market may experience frustration, sharp rallies, shallow retracements, and long periods where price refuses to go where consensus expects. That kind of behavior typically precedes a broader repricing, not the end of one. So here's the question for you. Are you positioned to benefit from this shift, or are you still relying on paper promises while scarcity quietly reshapes the market? Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.